Hello, traders. It is Wednesday, March 19th, Fed Day. So we've got the FOMC coming up today. That should provide us with lots of excitement. And if that wasn't enough for you, we've got triple witching on Friday, so we can expect some volatility. Harry, how are you doing?
I'm great. I'm great. Enjoying this crazy market. How about you, Pete?
I'm doing good. I thought you'd be great. You've been killing it. Been trading well. That's always nice, especially when it's volatile and difficult conditions.
It's about a 90% win rate this quarter.
That works. Yeah, but what if your losers are really big? Which they aren't. Oh, speaking of difficult trades, let's get into my recent pick that came out on Sunday. And I had mentioned to all of you what my game plan was. So I'm going to talk a little bit about the game plan and what I envisioned for the market this week and how that all unfolded. COF was my pick. And I was really trying to play bank stocks. That was the play. I felt that going into the week, we had a huge market sell off, 10% in the last month, and that bearish speculators, shorts, if you will, were going to be very, very nervous, especially with an FOMC statement coming, and especially since we had a light PPI, a light CPI. That gives the Fed a lot more breathing room. We also had the continuing resolution pass. So there were a lot of positives in the market. And what short would want to be holding big positions into the FOMC statement? Not many. So Monday and Tuesday, I expected to see a nice bid to the market and for it to be grinding higher into this FOMC statement. Now, bank stocks are most definitely going to benefit from a dovish Fed because the economy right now is softening. We want to see consumer spending increase. We need those interest rates to come down. So any dovish statements should fuel bank stocks. So the play was, let's buy a COF 175, 180 call debit spread on the notion that a dovish Fed statement is going to shoot the stock up, perhaps even to the 100-day moving average, well through the 180 strike price. Paid $1.10 for this Monday morning after the market opened. So the debit was $1.10. Our max profit potential is $3.90 on the stock. Everything is looking great. I'm getting excited. This is going to be a great trade. Here's the price action. Got in here on Monday, and look at that puppy grind. I'm thinking, yeah, I'm going to have some pretty happy people in here. Wham! What the F? I knew after that first long red bar, I'm like, ah, shit. I don't know what happened. There's usually not that much that can go wrong with a bank stock. They're boring. Well, it turns out that the Department of Justice said that there could be some antitrust issues with the Capital One DFS Discovery Financial takeover, and that's what the stock did. So instantly the position moved against us, but I was really watching the news to see what would happen, and I did end up buying some stock. So I bought it in here by the close. I made a little bit of money on it, but I kept a very close eye on it yesterday morning. I love the relative strength with the market selling off. The long and short of it is I took a fairly large position in it, and I made $2 on the stock, so it more than paid for my options position. Just want to mention that when you have something like this, the option bid-ask spreads widen way out. And if you need to do anything with the trade, if you need to adjust it in any way, shape, or form, don't forget, you can always trade the stock. And that's what I did. And so now I have a free position going into the FOMC statement. I'm going to keep it on. And you can see how the stock is back up to pretty much its high of the week. If I would have picked any other stock in the financial sector, like JPM, hello, great idea, excellent execution, would have had a nice profit going into the FOMC, and I probably would have taken profits without the risk of holding over that announcement. But I was in the wrong stock. Never saw it coming. So just wanted to give you that explanation because there are a number of factors that come into play. Mainly, what do you do once you get caught on a trade like that? Number two is financial stocks have been just phenomenal place to be. So my thesis actually did work out.
So I just closed my AMD trade. I just don't want to be long that going into the FOMC. I am still short SPY on the put debit spread I did. I bought back the, took advantage of today's early pop and bought back the short puts for a nice profit. And now I just had to get the long puts. You know, it won't take much of a drop here to get me a profit on the whole thing. I did have a question about that AMD trade. Why did I take AMD? And yeah, I could have held this. It still looks good. You know, you got to look at the daily chart here. And when you look at the daily chart, someone rightly points out in the questions, well, it's below all the SMAs. Yes. So this is what we call, what Pete calls a lower right-hand corner stock, right? And you can discount those. And if you're not an accomplished trader, if you're not someone who's, you know, comfortable in trading and know your way around and you regularly take profits, it's not a terrible thing just to have a rule to say, look, I'm just going to avoid bottom right quadrant stocks, right? That these, I'm just going to wait till these recover, get above their SMAs before I start going long. You certainly can short them, but going long. However, if you dig down a bit, you can find some gems here. And so if you look at AMD and you look at ever since, you know, you get this sort of on February 28th, you see it sort of basing here, right? You see support forming in the form of about a 2-week long consolidation, and very small candles here. And then all of a sudden on Monday, bam, it pops up out of that consolidation. Still lower right-hand corner stock, but now you have a stock that had relative strength on Monday. It was stronger proportionally to the market. That's what we look for. And yesterday, it barely moved, right? And then today, now it's strong again. The only reason I'm closing it, like I said, is the FOMC. So now you have the stock that kind of formed support, had a 2-week long, which is, you know, you're not talking a couple of days, 2 weeks, a decent chunk of time on that support. And then it pops up, and now it seems to be forming another base of support as it may decide to make a run for the 50 SMA. So that is why I took AMD. If it wasn't for the FOMC, I'd still be in that trade now. I don't think it's a bad trade at all. And I continue to make money and off Nvidia. I have been crushing Nvidia all quarter long. I've taken, let me see here. I mean, my God, I've probably taken on Nvidia, let's see, how many trades? Looks like over 30 trades here on Nvidia. And I mean, by far, I've only had 2 losses out of the 30 Nvidia trades. And, you know, like I was just telling Pete before we started this, Nvidia is a very unique stock to trade in that it's volatile, right? So as a trader, you want volatility. You want stocks that move. You don't want stocks like an ATR of like 2 cents. But unlike, let's say, a Tesla, and I'm not saying Tesla's bad to trade, it isn't. But unlike a Tesla or other volatile stocks, Nvidia tends to adhere to technicals, right? Obviously, you have news events, and we just had one. But by and large, Nvidia will adhere to the technicals. So you have a volatile stock that also adheres to technicals, and that's kind of what makes it a very good top tier stock as a trader for me to trade.
Yeah, you've definitely been killing it. And it does bring up a good trading point. When you dial into a stock and you're really in tune with what's happening with it, oftentimes we'll see a trader, they'll go into a stock, they'll make great money on it, and then they almost act like it's toxic after that. No, no,
Right.
no. I made my money on that. I'm done with that. Now I got to go find something different. That is such a crazy mindset to be. in, because you can keep trading the same stock over and over again. And I'm not saying that that's what you have to do, but you certainly can, especially when you're really dialed into the way that it moves. And especially when you've got, whether it's relative strength or volume, or you're bouncing off of certain price levels, don't abandon it. You're dialed into it. I've had a lot of my biggest winners have come off of an initial loss where I didn't expect. Oh, use COF as an example. I've had an initial thesis going into the trade and it doesn't work out. And as the trade evolves, I realize that I need to get out of the position, but it's still on my radar and I'm still watching it. And oftentimes we'll be in a trade at a critical price point where it could really move either way. And then all of a sudden you go, wow, now I see the true colors for this stock. It's not going up, it's going down. And then you attack that position and you make a ton of money on it because you are dialed in. You can see very clearly what's happening.
We got a good question here, Pete, on hedging. Now, I know you said many times, if you feel you need to hedge, you probably should either be in the position or you should lower your position size. I agree. What I think is, just to add to that relative strength and relative weakness give you a very unique hedging, non-hedging kind of proposition. Now, a normal hedge, right, would be, oh, I'm long, Nvidia, I'm long Home Depot, I'm long all these stocks, and the market's volatile, so I'm going to throw on some SPY puts, right? Or I'm going to short ES futures. And, you do a certain percent, right? So let's just say you have $75,000 worth of longs, and so you put a $25,000 worth of a short on. That's your typical hedge. So you don't do one-to-one on hedges, right? If you're $75,000, you don't put $75,000 in short. You might as well just not be doing anything. You just close all your positions. It's the same fucking thing. But if, for example, you're long, Apple, AMD, Nvidia, whatever it is, and you see a stock that is relatively weak, in other words, a trade you would take anyway. The only difference is that normally you don't want to trade, against the market. So let's say right now the market's going up, and if there was no FOMC, you'd say to yourself, okay, taking a short right now might not be the best, the best idea. But let's say you're thinking, well, I have a lot of long exposure. So the best case is just reduce your long exposure, right? Right. If you're not worried about it, just reduce your long exposure. But if the positions are working well for you, you can also look in and go, oh, okay, I see something like Williams-Sonoma right now is relatively weak. It has fallen below the 200 SMA. I believe it's an earnings drop here. That could be something where you could look at something like Charter Communications, right? Relatively weak today. Can't get through the 50 SMA. Now, that is a trade that you might take anyway. So the idea there being that if the market doesn't drop, your longs are still going to be good, but your relatively weak stock is not your hedge is not going to suffer too much because it's already relatively weak. If the market does drop, well, your relatively weak stock is certainly going to pay off. Maybe not enough to cover all those longs, but pay off. Best case, just close a lot of those longs.
Yeah, I am not a fan of hedging at all. I mean, back when I was in the brokerage side of the business, I would have so many big customers asking me to run the numbers and to create a hedge for them and to come up with exactly how to go about it. And I'd have to find out what their risk tolerance was. I'd go through the whole exercise. The bottom line is I'd tell them it's going to cost you about 7% to hedge this. They'd go, what? 7%? So that means the next 7% I make on the upside just goes to pay for the hedge. Yeah, that's right. Well, I'm not going to do that. Well, the long and short of it is too, that cash is flexibility. And when you have flexibility, you aren't worried about adjusting positions or what your risk exposure is. You have the ability to just jump right in and do what you need to do. You can hedge away all of your risk if you'd like, but you're going to hedge away all of your upside potential as well. Well, then what's the damn point? What is the point of doing that? Now, if I've got a lot of, let's say, bullish put spreads on, and I'm looking for market continuation to the upside, and I see the market makes a new relative high and there's a gap reversal, I'm going to short futures. Okay, I'm going to do that anyway. That's going to be my trade because I'm going to see that those signs of a gap reversal. And so by trading futures, by trading them short, I'm naturally hedged on my bullish put positions. I'm not looking for a long sustained market decline at that juncture, but I've got a hedge on, and unwinding a bunch of option positions is very difficult, longer term swing trades. So you can hedge on a short term basis, but those are really more day trading types of strategies. So yeah, I absolutely don't hedge. And oftentimes you'll find that hedges don't do what they were supposed to. They don't move the way that you had expected the hedge to move.
Agree. Uh, the chat room just now, and this just drives me crazy. And honestly, I don't know how to stop traders from doing this. We just someone in the chat room, which I just admonished, but shorted Apple right now, and it's okay. It's below VWAP. I get it. It's a little relatively weak right now, but you're trying to hit a curveball before you know how to hit fastballs. General rule. If you are a beginner, there are rules that you should follow if you are a beginner trader. And by beginner trader, I don't care if you've been trading for 10 years. Beginner trader, I mean someone who is not consistently profitable, someone who does not take profit out of their account every single month like clockwork. You are a beginner trader. You have not yet reached the stage where you are a profitable trader. If you are a beginner trader, follow some very basic rules here. If the market is up, if the stock is up, don't short it. If the market is down and the stock is down, don't go long. I don't care if it broke VWAP, if it has relative strength. Look at the market. The market is strong right now. Plus, you're heading into the FOMC, which is a complete, X factor. So you have this X factor coming up. You have a stock that is up for the day. You have the market up for the day, and you short it. Now, whether or not that particular trade works is beside the point. It is not a trade a beginner trader should do. Pete wants to short that, great. I short it, great. Dave shorts it, great. We know what we're doing. You short that, 9 times out of 10, it's just not going to work.
Yeah, and it's putting odds in your favor consistently every single time. And so you can't just look at, oh, gee, I made money on this trade, hence it was a good trade. No, it doesn't work that way. If you take bad trades and you make money on it, all you're doing is ingraining bad habits and bad practices. So yes, there's a lot of truth to that. I've had quite a few questions on the book that I'm writing, so I'm just going to give you a very quick lowdown on that. First of all, the system that I offer to members has all of the raw articles that I've written over the last 3.5 years. That is the basis for the book. As it turns out, when I put it to editor, they were like, oh my God, you got 3, if not 4 books here. So I've been going through the process of kind of deconstructing all of it and rewriting it so that there are going to be 3 books. First manuscript, my goal is to have it done in June, but the other part of writing and publishing is that it takes a long freaking time to get something from manuscript to bookshelf. And I mean, there's design layouts and all this other BS. And I didn't realize it was this hard, to be quite honest. I didn't also realize that I had 3 books. I'm excited about it, but earliest the first book will come out is probably December. So the advantage of taking the free trial and being a member is that you get to see all the raw articles, and they kind of read as articles. So there's not a flow. I've got them organized so that they flow, but they're going to be much more involved in the book itself with a lot more charts, annotated charts, and a lot more detail. It just may not flow as well. So hope that answers all of your questions regarding the book.
I know I'm looking forward to it. It's going to be, I'm sure you have more than 3 books of knowledge there, but 3-book series is going to be great. I hope all traders take advantage of it. What do you think of FOMC coming up, Pete. What do you think good old Powell's going to do?
Well, so I think he's going to be dovish. And what kind of threw me for a tailspin, let's go into the daily chart, and then I'd love to hear what your thoughts are on this. Is so we get this initial drop. You're always going to see a bounce off of a drop of this magnitude. And so we got the first nice little couple candles here. And I was telling everybody in my recent videos, watch for a pullback. If you load up here, you are going to have the crap scared out of you, okay? Because there's going to be a retest. That was yesterday. I got pretty aggressively long yesterday near the open. I did end up making money on those trades. I had to sweat it out a little bit. We never got the bounce yesterday, which kind of surprised me. And that tells me that the selling pressure was very heavy. I was looking for a quick test and a V bottom and see you later. Never happened. So I'm thinking that the statement's going to be dovish. The Fed has plenty of room because inflation has started to come in. Their GDP forecast is minus 2.5% for Q1. So they see the weakness coming. Now, if they ease, you would think that the market will rejoice and we'll get that nice big bounce. But given the selling pressure that I've seen, and here's kind of how my theory behind it I explained earlier was that if you're short and you're afraid of a dovish Fed statement, you're going to come in and cover your short positions ahead of that news and flatten out. So all of that buying pressure from those shorts should have produced a rally, but it didn't. There were still lots of sellers risk off longer term money. That's how I view it. So sellers were still strong enough to keep a lid on that bounce. And now I'm almost I'm flat. Apart from that call debit spread I mentioned, I'm flat. I'm going to watch to see what happens. My ideal is that the market does have the bounce and that we struggle to get to the 200-day moving average, maybe a little bit above it. If that happens, that bounce and that stall is my next big trading window for swing trades on the short side. I have been bearish since right here in December. I told you this shit was coming, and this is a storm, folks. Okay, so I see economic weakness around the world. This is not a U.S. story. Okay, so where's the growth going to come from? Where's the strength going to come from? So I'm looking for that rally above that 200-day moving average. If the reaction to the Fed, let's say the Fed came out and lowered a quarter point today, oh, that would be phenomenally good for the market, right? Probably not. It might spook the living crap out of the market because they would think, oh, what does the Fed know that I don't know? It must be worse than I thought. And then you could get maybe a brief rally today. And we just lost Harry, I think. So we'll try and get him back on. But you could get a brief rally, one-day rally on a Fed rate cut if it came today. Now, there's like a 1% chance of that happening. The market is absolutely not expecting it. I'm just trying to tell you what the reaction would be. You would think it'd be phenomenally good news, but that will be very short-lived. And then the real move would come probably overnight, which would be, oh my God, things are worse than I thought. And you would see the market roll over and play dead. What I don't want to see is a negative reaction to the Fed today, because then I am all of a sudden in chasing mode. So you get this big drop. Okay, we've had a big drop. Now I'm having to chase. We've had a little bit of a bounce in here, so not the worst, but yeah, if we get a negative reaction, it's going to chunk away probably 50 S&P points right on that news. So it won't drift down here and just go ka-chunk. So I've been looking for a bounce. I hope we get the bounce because that's going to set us up with some really good shorts as soon as that bounce plays out. I think, and let me take a look and see if I've got a couple of other questions I can hit in the meantime here. How about PLTR pick? Hey, PLTR, I liked it. PLTR has been gradually working its way higher, so it has not been able to get through the 50 days. So let's go back and find out what Harry's got as far as his view on what the Fed is going to do today.
Can you hear me, Pete? Or am I?
Yep, you sound good.
Oh, there we are. Okay, I was cut out there for a bit. Um, yeah, look, I agree. I think the market is in a. I think the Fed is sort of in a rock and a hard place position here, where before it was, oh yeah, cut rates, cut rates, cut rates. Now cutting rates, before cutting rates would signify mission accomplished. We're heading back towards lower inflation. We don't need to have such a restrictive policy anymore. Great, market loves that. Wonderful. But now, if we cut rates, the market might look at it and go, or if they come out as dovish as you might suggest, and the reason the market might not respond positively to it is, oh my God, they're afraid of a recession, that they need to start thinking about cutting rates to jolt the economy because they're legitimately afraid of a recession here. So it's interesting.
I think we might have just lost Harry again. So, in any event, we'll keep waiting for him to come back. I had a question on measured moves, and I had written about this. So, this is obviously from one of the members. So, measured moves, I like using them on the index, on the S&P 500, and I like using them more for rallies than I do for sell-offs. And I also, in this particular case, now we've got a crackdown. I would not use a measured move to gauge how far we could fall until we get the first bounce. Then I would take that low and that high from the bounce, and I would subtract it from the low, and that would give me a downside target. So that's how measured moves would work. The problem with using it on the bearish side is that bear markets take the elevator down and the stairs up, and you don't know quite how far they're really going to fall because they're very dependent on news. What's the nature of the drop? What caused the second leg lower? Is this becoming a credit crisis? Is this just a normal correction? So on the upside, the price action is much more predictable. And so that high and that low, you would take that range and add it to the top, and you get right about in here. So that's where measured moves work very effectively. And they tell you where that rally should be exhausted. So I like using them on the index, and I like using them in rallies, but not so much on decline.
Where'd you lose me, Pete?
Okay, so I think we lost you on the Fed. It almost becomes a situation where rate cuts might be viewed with a raised eyebrow that maybe the economy is worse than we thought.
Yeah, so hopefully you don't lose me again here, but it'll be interesting to see how the market responds because, as I said, I don't know if you heard before, but 6 months ago, a rate cut obviously would have been seen as a bullish thing. Mission accomplished. Inflation, we got it done, under control. Now it could be seen, or any dovish remarks could be seen as, oh shit, they're worried about the economy here, and they're starting to think we now need to do rate cuts to jolt the economy. So it really depends on the market does not seem to be in a very forgiving frame of mind these days. So I don't know. They could. My bias right now is a bit to the downside. That no matter what the Fed says, the market might be able to interpret it as a bad thing, but that's simply because that's kind of where the zeitgeist is.
Yeah, exactly. And so the soft landing, when you said mission accomplished, that was like, oh, we're going to get the soft landing. It also reminds me of George W. on the aircraft carrier 2 days into the war.
Mission
And then we
accomplished.
spent another 10 years in Iraq. Anyway,
Yeah.
as far as the soft landing, well, wait a minute. Minus 2.5% GDP for Q1. That's not a soft landing.
No.
We're headed down. And so what we've seen
is a Bowen landing.
Yeah. We've seen central banks around the world cutting interest rates. They are much more concerned with economic growth than they are inflation. And that's why they've been doing it. And so, yes, this now is coming to the US as well.
I see. I heard you did talk about PLTR. I just wanted, PLTR is underneath it's SMA on the daily chart. I mean, a lot of people, I get it. A lot of people who are asking questions, you haven't been in the chat room. You're not part of the community. You don't know the regular checklist things. But please, if you can hear one thing, daily chart, daily chart, daily chart. Just put the 50, 100, and 200 SMAs on your daily chart and treat them as gospel. Treat them as support and resistance lines and look at them. If you did that on PLTR, you will see right off the bat the 50 SMA is right above it, but it is bullish. I would set a nice alert there at 88, which I'm going to do right now. Set an alert at 88 on PLTR. And if it hits that, I would consider going long. But yeah, look at the daily chart, guys. Really, it should inform all of your trades. The SMAs are there. They in most cases are respected by the institutions, unless you have a market or news or situation that gives you a reason to violate the technicals, obviously.
So let me give a quick explanation on PLTR, what I liked about it. What I liked was this bounce off the 100-day moving average. You can see where the 50-day and the 100-day are converging. The stock is compressing. It has relative strength. My theory for the trade, buying it below the 50-day moving average, which I would not normally do, is that you've got the bounce off of the nearby 100-day moving average. You're in a compression. It's going to need to blow through the 50-day moving average. When it does that, it's got an easy path higher. That's why I like entering here below the 50-day. And you can see that was a good entry. You're basically at break even right now, but you didn't get what you wanted, which was the blow through on the 50-day. And the reason you didn't get that was because the market has been weaker than I thought. The bounce didn't really materialize very well. So it's a no harm, no foul. You evaluate the trade, and if conditions are changing, you adjust your trading, which brings up a question that someone had. Pete, I see you scale in, but I don't see you scale out. Well, I just scaled out of positions yesterday when I got long early yesterday, and I exited a SPY call position yesterday, and I exited some of it this morning early, then I exited some of it later. When you are posting trades, and I'm balancing so many different things throughout the course of the day, the chat room and my posts there are probably 10% of what I do. I don't have time to post 5 exits and 5 entries. So I'm just giving you a general idea when I'm in and when I'm out. But when I'm trading full time, I'm absolutely scaling in, everything good, good, good. Then I start scaling out and taking my risk off.
A lot of questions on swinging in this environment. What's the difference between swinging in this environment and a bull market environment? When we are in a bull market, until if we get another 10% drop, then we can revisit that. But obviously, we are in a correction area right now. There is a bearish downtrend. First off, always more difficult to swing shorts than it is to swing longs. Period. That's it. Why? Because let's say I go long Nvidia, right? At 117.77. It's fucking Nvidia. If I'm long that stock and tomorrow at FOMC and it drops down to 15, okay, I can take that loss. Or, you know what, Nvidia is going to recover, right? Unless I see a really serious technical breakdown on the daily chart, unless I see it go below 104, right, which is that low there, and I see it violate those trend lines, I'm not that worried about being long Nvidia here. However, if I shorted Nvidia and Nvidia goes up, well, that is difficult to hold, because it is quite possible Nvidia is never going to see 117 again. And, you know, a year from now, Nvidia is at 220. You could lose a tremendous amount on shorts because you're not able to hold them. Now, in a bear market, that's a little bit different. But right now, you're not there yet, and it's not comfortable swinging shorts. However, most of the days, shorts have been the better trades. So it's difficult and you notice I've been swing trading, day trading a lot more because it is difficult to swing those shorts. But I have been swinging certain longs, but the longs that I swing, Amazon, Nvidia, Apple, I like swinging long stocks that I'm comfortable holding to a drawdown. I have to be comfortable holding that drawdown on the stock if I'm going to swing it long.
Yeah, and so way different mentality when you're trading the short side than when you're trading the long side, because the market takes the elevator down and the stairs up. And so what you're going to find in this chart is you're going to find, first of all, you have to confirm that you are in a bearish market and that there's a correction coming. Okay. Otherwise, you're picking market tops and you're going to get carried out in a body bag. So this breakdown in here was the first real time that we could say, all right, we breached the 100-day moving average with ease. We can start considering shorts here. We couldn't really consider them up here. We maybe had some stocks that we could have shorted, but as far as the market, this is where we can get aggressive. So when you get these big drops like this, you're going to get these massive snapback rallies, and you can't wait for that low to be established, because oftentimes you'll gap 50 S&P points higher the next morning and you'll keep rallying. So you have to take your gains into those really deep drops. And on a swing basis, you go to the sidelines. Guess where we're at right now? We're on the sidelines. We have to hope and wait for a bounce. If we don't get it, okay, well, then we can adjust our thinking. But for right now, we have to assume that we're going to bounce, because that's what oversold bearish moves do, is they produce those bounces. Once that bounce stalls, we want that bounce to be less than half of the distance from which it dropped. And if that is true, then that tells us that sellers are still in control, and we watch for the market to start losing its strength. That's when we take swing shorts. We get those big drops. We can add when we take out that prior horizontal support, and we take gains into those big red candles. Most traders don't do that. They do the opposite. I don't know, this move's gone down awful far. Oh, Jesus, it's gone down so far. I can't chase this. And then it reaches the point to where they're like, oh God, the world's going to end. I think I'll short right now. So they take a short position, and then the thing absolutely skyrockets and they're like, oh my God, I was wrong. It's going to a new high. So they exit their shorts for a big loss. Maybe they even get long, and then the bottom drops out. I mean, they could not time it any worse. So yes, it's much more difficult. And as Harry was mentioning, let's take a quick look at the monthly chart of the S&P 500. When you are shorting, this is what you are trading against. Yes, you don't have as much staying power when you are short, because you don't want to get caught on the wrong side of that. This is a monthly chart, by the way.
See, we got a lot of good questions this time here. I like questions that are not, what do you think of this stock? I mean, without anyone putting thought into the question. I like more of these philosophical questions. So here's one, something else I wanted to bounce off you guys. I know you're predominantly swing traders. Well, actually, in this last quarter, about 75% of my trades have been day trades, but I'll grant the past year or so, it's been mainly swing. Something I noticed from a day trading standpoint is that often on a big market down days is the high flying longs that have been strong get taken out at the ankles and have a large down moves as people panic sell to protect their gains. And stocks at relative weakness tend to float around break even or even up on the day. Is this your experience also? Do I need to work on my short watch list? Well, I think you have a little bit of selective bias there, right? Where you're recalling stocks that do that, and obviously stocks do that. But you're forgetting, I mean, go back to March 10th, look at Tesla, right? market's down, but then look at what Tesla does. Tesla's dropping, 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 dropping. It does not stop dropping. There's no bounce there. If you shorted Tesla at any point during that day, you were in profit at the end of the day. Um, Obviously, many stocks, there's going to be a pause, right? There's not going to be continuous unless there's a news event or something, nonstop selling going on. There are these pauses, and what it looks like is you get this break in relative strength, the relative weakness. The fact of the matter is you just go with the trend, right? If you have a down day and you have a relatively weak stock and you short it and you get this bounce, it's most likely testing VWAP. Use that as your guide if you're doing an intraday trade. If it breaks through VWAP and then confirms above it, then you get out of the trade. Most of the time, you're going to get this bounce off of VWAP and it's going to head right back down again. So I think you have a little bit of selective bias where it's always easy to remember the times where you shorted something or you went long something and you got burned.
You do make there's a good point to, everything looked fantastic and the stock was running higher. And then all of a sudden it got its legs chopped out from underneath it. And so, yes, that is true that happens. And so here's something that you should keep in mind. You got the go-go stock that's running hard out of the gate. Oh boy, look at this thing go. Oh, it's going to go to the moon. The volume is high and I'm just going to buy it right here. And then it pulls back. And right about in here, you're worried about it. And you've got a dog on your hands, a big loser. When you get a steep move like this, say 60-degree slope or higher, it's not sustainable. Are you freaking kidding me? What did that company do to deserve such a high valuation in the matter of an hour, hour and a half? Even worse is like a commodity stock that somebody charges after and chases. It's going to pull back. So you wait for that test and you wait for that pullback, and it's usually going to be somewhere around VWAP, maybe a little bit higher, maybe a little bit lower. You want that pullback to be very stubborn and you want it to take a long time because that's going to tell you that buyers are still engaged. You wait for the pullback. You set alerts based on that pullback. HA reversal, it was relatively strong, then it went relatively weak. Now it's relatively strong again. We have all these alerts built into Option Stalker Pro to do exactly that. Flip side. Nice, steady, grinding stock that does not get ahead of itself, that opened a little bit higher than the prior's day close, has good volume. This baby's going to continue to grind the whole day so you can add. What's the net result of both patterns? About the same. This one just took off early in the day and you chased it and you needed to wait for that pullback. If you had done that, you would have made nice money on it.
Question on Amazon. Looks weak versus market, but in this wedge above the 330 I don't know what the fuck a 330 SMA is. The 330 SMA. Okie dokie.
I like the 325 because it gets me in a little earlier. Personally.
Well, I've been using the 327.5, but 325 sounds good. I'm going to give that a try. Thanks, Pete. I mean, okay. I might assume that's a joke. I don't know. I hope it is. But one of their thoughts on Amazon. Look, Amazon, it took me 2 seconds. I look at the daily chart. I looked at, you go to the bottom of 1210, connected to the bottom of 1218, connects to the bottom of 1220, connects to the bottom of 310, and then you get yourself a nice descending trend line right there, and it comes right in at 187. I right click on that trend line. I say set the alert. It breaks the trend line. Guess what? I'm shorting the hell out of Amazon. It bounces off the trend line with relative strength. Guess what? If it confirms that, I might be going long. Until then, I'm ignoring it.
My market prediction for 2025, I called it correctly. What do I see the rest of the year? By the way, all of you should go back and go back 5, 6 years, look at every single video at every major market inflection point. I was all over it, and I was right on that before the move even happened. So it all comes from reading price action, and that's how I do it. The rest of the year, I'm not optimistic. I see that stock valuations are still very high. I see that economic conditions are deteriorating here and globally. And I think that this is going to continue to move lower, perhaps into September. I don't really look further than a quarter, but I think that earnings this time around are also going to be pretty soft. So that starts soon. Actually, I think 2 weeks, 3 weeks, maybe. Earnings season starts.
Yeah, very soon. Actually, it's coming up. I agree. And look, I'm a free market person. I've never loved tariffs, whether they come from us, whether they come from other countries. I think tariffs are restrictive to free trade. I think the markets around the world do not like them, and companies do not like them. Hopefully, we get a resolution. So I think depending on, trade wars are not good for either country. So seeing as how that goes, there's a lot of X factors. There's a lot of geopolitical things. Obviously, the Middle East, that war has now become a hot war again. Will there be peace in Ukraine and Russia? There's now the new situation popping up in Iran. All these things, they affect supply chains, they affect oil, and trying to dig through that, like Pete said, you just got to look at the price action. You got to look at where, the market is taking you. The market's had a hell of a run in the past 2 years. So, if we end 2025 with SPY right where it is right now, I would not be surprised.
Let's see. Yesterday, Pete, would you say yesterday on the early gap down, the circumstances to go short stupid? I shorted Google. While actually I was in completely the other camp, just based on experience. There's nothing technical that I can tell you about why I felt so bullish here outside of the fact that I know the first bounce is usually going to be challenged. And yesterday was that test. And when I saw it early on the open, I'm like, this is the test. I've been waiting and I'm ready to load here. So no, I was not looking to short anything, but you wouldn't really have that information. I think anytime that you're wanting to short or go long in the first 30 minutes of trading, that should be probably 2% of the time. Hardly ever. There have to be some really extenuating circumstances for me to want to pound something early in the day. And so we can take a look at what Google did during the first. Yeah, so now you can see these stacked candles. Now I'm chasing a stock that rarely makes a move like this. I mean, if I went through and looked at, you're not going to see a lot of moves like that. Okay. If I look back, how many moves like that did I get in Google? What happened? What made Google so shitty overnight? Really? Was there something that major that happened? No. There's probably some programs that came in and knocked that baby down. And that's a pretty risky move. Although you can see it did happen on heavy volume. So maybe there was some news on it. If you're going to chase like this early on, just like the chart that I showed you before, when you get a sustained move like this with a very heavy slope, if you had shorted stupid 15 minutes into the open, then you also need to be ready to buy when that low is down in here. Done. Trade over. Do not have visions of grandeur that Google's going to go down from 160 right now after a big fall like that to 150, and I'm going to make my vacation money today. No. It's a nice move. You had good momentum. You had volume to support that decision. Be ready to take profits because you know at minimum you're going to check VWAP and probably even then some.
this one here is a quick answer here. What I think about using leveraged ETFs to swing, I think it's to do yourself a favor. Paper cut each finger for every day so that you're swinging a leveraged ETF. And on the 5th day, wash your hands in lemon juice. That's exactly what you do. Because leveraged ETFs reset every day, which means you get killed on, let's say the stock goes nowhere, right? Let's say you got a short ETF on MSTR or whatever. And let's say you took it and it's 298.98 right now. And at the end of the week, it's 298.98. Guess what? You're down. You've lost, because that leakage will continue to pull you down. So short-term day trade, maybe, yes. Swinging them, you're just kicking your own ass. So that was a quick answer there. But so is it, can I talk about account management? In the worst case, how would you handle a red month or a couple of red months? I haven't had a closed trade red month in over 4 years. And I say that, well, because I'm fucking awesome, but also because it's a business, right? It is a business, and you have your budget. If you set your budget and say, I'm going to make $10,000 a month profit. That's what I mean, $120,000 a year. That's now my new full-time job. Let's just say, I'm rounding numbers. Great. And my standard deviation, meaning how much do I vary from that, is $1,000, or at least let's make it even what, $2,000. That means 68% of the time you make between $8,000 and $12,000 a month. 95% of the time you make between $4,000 and $14,000 a month, and 99% of the time you make between $2,000 and $16,000 a month. Great, that's what you need, because only 1% of the time are you actually having a red month. So if you have consecutive red months, you're doing something wrong. You have way too big of a standard deviation there, which means your trades are varying way too much in terms of their size. You're getting big wins and huge losses. You do not want that. You want consistency. You want to be able to say, I know I can pay my rent next month or my mortgage. I know I can buy food and go on vacation and do this, because even before the month starts, I can say with almost 99% certainty, I am making this much money trading this month. And how do I know that? Because I've been making that much month after month after month. That's why it takes 2 to 3 years to build up to the point where you have that confidence in your own statistics that you can open up your business. If you're not ready to open your business because you're getting these red months in a row, well, you need to go back to paper trading. You need to go back to trading one share until you can get the stats to back up opening your own business.
Amen on that. I've had a losing day, maybe a handful a year, a losing week. 15 years, maybe, a losing week. I haven't had a losing month. So don't get discouraged. You got to go back to the drawing board. Okay. Losing days should be rare. Losing weeks should be extremely rare. A losing month should never happen. Now, let me qualify that. The first 8 months that I became a pro in 2002 to early 2003, I had about 6 to 8 losing months. Now, they weren't just brutally ugly. Oh my God, I had no freaking clue of what I was doing. It was just this gradual Chinese water torture. And I had about $7,000 a month in expenses. So I include that in my losses, because you've got to make money. I had a family of 5. So I've got to pay for health insurance. I've got a lot of overhead expenses. Those are the realities of being a professional trader. And you have to make enough money to cover those expenses at very minimum. So, I mean, I hate to hear that. If you're a professional trader and you've got more than a losing week, you probably, and I say this sincerely, should have a secondary source of income. Okay. You've got to at least be working part-time. You can't put that kind of pressure on yourself while you're learning. And go back to basics, trade one share, focus on the win rate, get the win rate up. And write extensive journals. What the F is going wrong? What am I not figuring out here? You have to avoid those times. I mean, I don't know how else to put it to you.
It really is one of the core tenements where people don't realize how much trading needs to be like a business and treated like a business. Anything that you're doing for profit needs to be treated like a business, and trading is no different. What is the difference between the Real Day Trading Discord and the OneOp chat room? Well, Real Day Trading Discord is obviously it's a free chat area where a lot of traders come in and post their trades. The OneOp chat room is you get, obviously Pete's in there full time, giving his market analysis, every hour or every half hour, some trades are being posted. Dave W is in the OneOp chat room. We have there's a lot of experienced and pro traders in there. I moderate that chat room. I'm not an employee of OneOption. I'm a member, but I love moderating the chat room for Pete. And look, I mean, this is what I think, Pete, a 2-week free trial. You come in, check out the chat room and see what you think. But, the tenets are the same. The principles behind the types of trades that you see are going to be similar in both. But you have a more pro traders, obviously, in the OneOp chat room.
We're laser focused too. I mean,
Yes.
Harry and I don't put up with any bullshit. Okay. It's so if you need entertainment and you want to post memes and stuff like that, it's not the place. We want to post trades. We want high caliber trades. If we see people posting garbage, we're going to call them out on it, especially if it doesn't fit the system. You're going to get my play-by-play analysis throughout the course of the day. I'll tell you what the market's doing, and I'll keep you on the right side. You're not going to get that anywhere else. I did have a question here that I wanted to get to. Oh, what was my oh my God moment? My oh my God moment came in March of 2003. And speaking of mission accomplished, it was pretty much when George W. made that statement, because what had been going wrong for me the first 6 to 8 months was that the market was drifting lower and just ticking lower. And then we would have these short covering bounces. Very, very difficult market to trade until we invaded Iraq. And that was the dark cloud that was hanging over the market. And it wasn't that I didn't have skills. Part of it was not recognizing the market conditions. So I obviously honed my skills in a bear market. And I view that as a benefit. And then once the market released, oh my God, it was like shooting fish in a barrel. And that's when everything just started to click. So, I can't say that there was a real aha moment. There are many little pieces of the puzzle that came together throughout my career. Relative strength is one, definitely, that made a lot of sense, and market first also. And then I kept adding components to it, all of which you've read about in my articles or will read about in my book.
Oh my God. The 330 SMA is something the trading edge community uses. A lot of RDT members overlap. There's evidence to suggest it's an SMA used by institutions. One example, Apple bounced off it on 313. First, let me tell you, use a random, go to the 250, 270 SMA. You will see on any chart, there's going to be a day that one of those candles bounce off that particular SMA. When you have that number of candles, they're going to bounce off a price point, not because the price point matters. It's just random. I have worked with institutions for quite some time. I've worked directly with JPM. I get JPM's reports every single morning where they talk about, and they have a whole section on the report about technical analysis. I've gotten that from Goldman Sachs as well. I can guarantee you with absolute certainty that not one of those reports, not one of those conversations in the past 2-3 years has ever one time mentioned the 330 SMA. It is in your head. It is not real. So I don't care what community uses it, don't use it. It doesn't work. It is not viable. So, but thanks for telling me that it wasn't a joke. I thought it was, but and yes, Christopher H. Pete and I have tried. Pete, my God, how many other? They asked, relative strength, relative weakness. If we always been trading that, how many other things have we tried? My God, Pete, how many different things? I would say confidently, if it's out there, we probably have tried it.
Yeah, I have absolutely seen it all, tried it all. When you're managing thousands of brokerage accounts, you get to see everything. And that was how I spent the first 15 years of my career, institutional and retail and professional trader. So, and that was back when you do verbal order entry over a telephone. I know that seems archaic, but you get to know your customers and you get to know what they're thinking and what they're trading, and you get to see who's successful and who's not. So those experiences have definitely played a role in the system that I've developed and the way that I trade. And Harry, if there's overlap or there are people that are in your Discord and in Trading Edge, you should check out who Trading Edge is, because there's a lot of bullshit out there, quite honestly, and we should find out who these people are. See if
Yeah, I'm
they
gonna
could be legitimate.
doubt it, but
95%
I'll
of the
check.
people aren't.
I will check it. I mean, look, Pete and I have certainly run through every single one of these people. Not look. There are a couple of Tom Houligard. I think he's great on mindset. Right, he trades large scale ETFs, but for mindset, I think Tom Houligard's Best Loser Wins. Good book, recommend it. There are certain traders out there, certainly in certain books out there, that are useful, and some of them are very dry, some of them aren't, but there's some that are useful. There are tons of communities out there that claim that they have the secret, and at some point they want to charge you something for learning to take their course or something like that. And it's a very simple standard that Pete and I like to give. It's very simple. They have to prove to you, right? Prove to you that they are profitable. And I don't mean they occasionally post this, or they show a image of their account, which can be Photoshop, which can be altered. To me, the only legitimate way, and this is why I do this. This is why for the past 4 years I have been doing this. You can go back 4 years, and if anyone wanted to put the time in, you can verify it. You post the trade as I do them, right? I go long Nvidia, right? Boom, I post the trade. This is the price I got in. This is the number of shares. Did Harry really make that trade? Well, you know what? Every single broker has time and sales. You can just look. I said I took 50 call contracts. It will show up there right on time and sales. I said I got 5,000 shares. It'll show up there. 5,000 shares. This is the price at the time it was taken. So now okay, he really took that trade. Then I post the exit of that trade when I exit it. 2 to 3 second lag. Look on time and sales. Did he really exit it? Yes. You can then see the profit. You can then look at all of my trades, right? Which I keep in a journal, but you can journal them yourself. You can look at them and you can see, okay, this guy is profitable. His trades are profitable. He has this win rate. It is proven. I cannot go into brokers and alter time and sales. I cannot Photoshop time and sales. I cannot do shit to it. It is there and reported. So any other way that someone wants to claim that they are a profitable trader, challenge that. Because if you find someone that's profitable, great. Follow them, listen to them, great. I have not yet found anyone who is doing these communities that can live up to that standard of absolutely profit. Even Kinfo can be manipulated now. You can even manipulate your Kinfo results. So that to me is the standard, and it should not be that hard, particularly if they're going to ask you for money to learn from them. It should not be that hard for them to say, I entered this trade at this price and this many shares. You look at time and sales, it's there, and then I exited and you look at it's there and you go, okay, this guy over the last month has made X number of dollars with this win rate and this profit factor. He's now done it 4 months in a row. I'm convinced they know what they're doing. Hit that standard, then talk to me about a community.
Yeah, you have more transparency than anyone I know. And if you want to verify what I claim, go back and watch the videos. 2019, look at how I traded 2019, what my trades were. February 2020, look at what I was telling everybody about COVID. I was ahead of the COVID crash. Look at how we were selling naked puts and getting long in May of 2020. We rode that whole freaking move back up like absolute champs. In 2022, called the bear market in 2021 of December. November 2023, buy with both hands, get as much as you freaking can because this thing is running hard. And look at every video after that. And then my market forecast that came out in December 2025, we're going to be heading lower. Go to cash with your swing trades. Tell me one person that's got that kind of track record, anticipating those moves before they happen. And if you can find someone like that, please let me know because I'll follow them too. I can always learn something.
I mean, I appreciate Ram Kumar is saying basically, what do I think of CERN Carson, who does volatility related content? Is there a way to add to our edge using Vanna and Charm? And just to show you, look, you have to be knowledgeable about all of these things, and I strive to be as knowledgeable as possible, particularly to answer your questions. Vanna and Charm, just briefly, Vanna is measuring, implied volatility changes. How is that going to impact your directional exposure on delta? And Charm is going to track your delta exposure changes as time passes. So it's sort of like a time decay type effect or whatever. Here's the thing, it's sort of like advanced calculus. You have to be very, very quantitatively oriented, and he has the tools to use that. And what they're looking for in doing that is a very small edge on taking advantage of these things through Vanna and Charm. And if you want to deeply understand market mechanics and you want to basically put yourself through an intensive year to year and a half long course on translating the Greeks into actionable trades, be my guest, you will probably get a slight edge doing it. I do not think it is necessary. I don't think it is worth the time you have to put into it to get the edge back out of it. And you also do need to have a pretty strong quantitative background to really understand it. To think that you can just jump in and just take what he's saying and go, oh, I can apply this to myself. That's where the scam comes in, right? That is not the case. You need to have a deep and seated. I'm a former statistics professor, and it would still take me time to read up if I wanted to apply those metrics to trying to get a deeper option edge on the Greeks. So, sometimes something could be even legitimate, but the scam is in trying to convince you how easy it is to apply.
Yes, and a lot of those guys, what they're doing is they're trading volatility term structures, and they have baskets of positions on indexes, and they're trying to maintain delta gamma neutrality. They're constantly adjusting. They really don't have an opinion on the market, but they have an opinion on volatility, and that's how they trade. I will tell you flat out, 100%, your best, most lucrative way of making money is to be a directional trader, not to be messing around with all that stuff. But the problem is that you have to be patient, and you have to wait for your windows to set up, and you have to have a market opinion, and you have to have confidence in it. If you've got those things, then being a directional trader, you don't need to monitor what VIX is doing and what VXX is doing. It's great if you see these spikes. They're oftentimes an indicator of a market low. That's where I've found through 35 years of experience where VIX is of value to me. Okay. Anything else, I don't care about it. I don't need it. I don't watch it. If the market is telling me that it's going to go higher, I find the stock with relative strength. That tells me institutions are accumulating it. I've got additional cushion in the trade. My market analysis is good. The stock's going to move higher, period. Easy. Keep it simple. You'll make a lot of money that way. It keeps going. You keep adding to the position, and then you exit. So you're scaling in and you're ramping up when the conditions are right.
And then, of course, someone wants to know, what do we think of following big names like Buffett for swing trading? You're not swing trading, then you're investing, right? Swing trading is you're taking
Warren
a trade
Buffett
now
said,
and you're closing it in a week, 2 weeks tops, maybe a month. Oh my God. Buffett, you're not going to get you're going to have to wait a quarter before you find out the changes that he's made to his portfolio. How is that swing trading? You want to look at Buffett and go, this is what he's divided up his portfolio in. That's where I want my long-term investments to match. Go right ahead. Probably a smart idea. Save you a lot of time. You want to take his golden rule of, hey, buy good companies that bounce off the 200 SMA. Hold them and just hold them and not trade them. Again, that's investing. That's not what we do here. You want to use Buffett for swing trading? Okay, good luck.
Warren Buffett, one of his quotes is, if you can't hold a stock for 10 years, then you have no business holding it for 10 minutes.
Yep. That's your Buffett rule. Buffett is not a trader. Buffett is one of the greatest institutional investors of our time. He has boiled it down to very almost simplistic rules, and he makes mistakes. He bought a huge chunk of Occidental Petroleum, which he is way underwater. He has sold stocks before they've popped, but generally Buffett's going to beat the market. And if you're an investor, he is not a bad person to learn from and follow. We are not. That's not to say Pete and I don't have investment portfolios, right? That's not to say that we don't have long-term investments. We're traders, right? That is our area of expertise. If someone came to me and said, give me advice on long-term investing, I'm going to say, go speak to a long-term investor that has expertise in that. I will give you expert advice on trading, not on long-term investing.
Harry, we should come up with our picks here, because
Yes.
we got the FOMC coming up. So what do you like? What do you don't like? How are you going to position yourself? Any game plan here?
It's I like, and I know I sound like a broken record on it, I like Nvidia. I like Nvidia because I think you had a low put in on March 11th. You had a bounce off of that. You have a little bit of compression here. And I think you get this convergence of the 250 SMA up there at around 128. That gives you $11. And unless you're going to get this huge market drawdown. Now, again, a lot depends on FOMC. A lot depends on how the market's going to react. Obviously, you get this huge bearish reaction to something. Don't go long, right? Wait till you see support hit. But barring that, I think that at some point, Nvidia is going to test those SMAs, and that can give you a good $5 to $10 pop. So my pick would be Nvidia.
Anything on the short side you like, or are you going to stay pretty much with and let me qualify that. Very important. This is on the premise that we have a good reaction to the FOMC statement. You are not out there advocating that we buy right now, or that we buy Nvidia if the S&Ps are down 50 points after the announcement, right?
100%. Short side, target.
Target, yep. I noticed that earlier today.
I would take target on the short side, Nvidia on the long.
Yep, that looks like a good short. And look, so here's the tell. I always like to go in and show you. Look at this bounce in the market right here. Okay, so the last 3-4 days, the market has been moving higher. What has Target done? It's on its low because there's so much selling pressure. So yes, that is a nice short. And even today, the stock has not been able to get off the deck with a nice market rally like that. See? That's relative weakness. You get a weak FOMC reaction. See you later. My short pick. I like Pepsi short. Found that one early. Oh yeah, look at a dog around here.
Oh yeah, love that.
I noticed that one, and I love the fact that it couldn't get through the 50-day moving average.
Yep.
It dropped back below it. You've got resistance at AVWAP-E. So yeah, the stock this week has not been able to rally with the market. It's also on its low, and it's got room to fall. So I like Pepsi on the short side.
I like your short better than mine.
All right, well, let's load up on it. My MicroStrategy was another long that I gave you. I didn't mention that one on Sunday. So you can see that's been a really, really nice one the last few days. So that was actually a decent pick also. There's where it opened on Monday. It's higher. So that was a decent long. On the long side, I like the bank stocks. If the Fed reaction is positive, it's going to be because they're dovish. If they're dovish, bank stocks are going to like it. You can look at Goldman Sachs. You can look at JPM. Obviously, we've got our COF trade on. So I'm going to give you a different pick because I've already given you bank stocks. But that really is what I would be focusing on. I do like IBM. And if tech gets a bid off of the positive FOMC reaction, I think IBM is one of the stronger tech stocks. And I would like to see it get through this AVWAP-E and to challenge it pretty easily. The other one that I like, maybe even a little better, is OKTA. And there you can see how the stock has been right up on this horizontal resistance, and the stock hasn't done much today. So I need to see some volume in it, and I need to see it get through this high right in here, and it needs to make steady progress towards it. So that's what I would kind of be watching. You can set some alerts on it and set an alert right here on that high, and then that'll tell you when it's time to consider this stock. But there you've got a good earnings reaction. Market sells off unbelievably in the last month right here. And you can see how the stock held that breakout beautifully. And now buyers are getting a little bit more aggressive, and they will take out that high if you get a market breakout. I can't end this video without this statement, Harry. This is so important. This is only a fucking bounce, okay? This is only a bounce. You're an idiot if you trade this bounce, unless you're a pro and you're keeping your leash really tight on these stocks, because the big trade is coming, and it is coming on a failure of this bounce around that 200-day moving average. Can't get above it. That is when we're going to take swing shorts. Don't take your eye off of that prize. That is the trade setting up for the next 2 months.
Love it. 100%.
All right. Thanks so much, Harry.
Thanks,
We'll try and do these once a month. That's about all I can fit in right now, time-wise. And every week, Harry is doing his live events on X. So even though I'm not a part of it, you please join those. Those are phenomenal. The reviews that I hear from it are incredible, because you're answering everybody's questions, and you're providing a lot of great trading information. So please make sure that you check those events out.
Great. Thank you, Pete. And thanks, everyone. Good trading.
All right. Trade well, everyone. We'll see you soon.